Hello and welcome to another session of the My Solo 401k Financial, My Community weekly deep dive YouTube session. We go live every day on our community, mysolo401k.net/webinar. You can find the links. We go live twice a day, but we like to have these deep dive sessions at least once a week on YouTube here. So if you're on YouTube, please like and subscribe. You can chat over questions if you're on YouTube or LinkedIn or the StreamYard or even Twitter. So please chat over questions as we'll go through those questions for sure at the end. But we want to get into the deep dive content here, which is the 2024 and 2025 Solo 401k contribution guide, specifically designed for a business that's taxed as a sole proprietorship. Could be a single member LLC taxed as a sole proprietorship, or someone who otherwise reports income on Schedule C of their 1040, like a 1099 independent contractor, 1099 NEC independent contractor. So the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Please subscribe for access to upcoming webinars. For example, we're going to talk about how much income you need to be able to maximize contributions. So the magic number, that's going to be one of our upcoming sessions on here on YouTube. We're going to talk about mega backdoor Roth, solo 401k deep dive guides. So tons of educational content. If you subscribe to YouTube, you get the notifications. You can come live and ask questions. So today we want to go through A to Z 2024 and 2025 contribution guide. So we're going to talk about contribution limits. We're going to then apply those limits to different scenarios and examples, how to use the resources like our online calendar. We're going to talk about the deadline. We're talking about how to make contributions, how to report contributions, what is not a contribution. And then we've got the bonus content, which is the $1,500 solo 401k tax credit. So as mentioned, the focus for today is businesses taxed as sole proprietors, or a single member LLC taxed as a sole proprietor, with the income reported on Schedule C of the 1040, could be an independent contractor. Last week, we had our deep dive session focused on S Corps and C Corps. So if you go to the YouTube channel, you can subscribe, you can access the video history there, see last week's session. We'll have another one coming up focused on businesses taxed as a partnership. And then, like I mentioned, the magic number sessions, the mega backdoor Roth sessions. So we're going to keep coming with the educational content. Anytime we talk about how much you can contribute to the solo 401k plan, we want to start with the basics. And I think it's helpful to understand that one's ability to contribute is going to depend on different factors, such as your age, such as your self-employment income, whether you participate in another retirement plan, like a day job plan. And then, of course, the type of contribution that you're looking to make, whether it's employee versus employer, et cetera. So digging into those factors, number one, again, you can't save more than you earn. So your ability to contribute is going to be based on your self-employment income. What that means depends on how the business is taxed. For example, for a business taxed as a sole proprietor, or a single member LLC, or an independent contractor reporting income on Schedule C of the 1040, you have to run a pre-calculation where you take line 31 of Schedule C less 1/2 of the self-employment tax. And that is considered to be self-employment compensation. That is what you're able to contribute based on. Now, you can't use wages from other sources like a day job to justify solo 401k contributions. You can't use investment income. So here's a good visual just showing that calculation. Again, you take your net self-employment income, which is reported on line 31 of Schedule C, less 1/2 of the self-employment tax. And we have a calculator on our website that will run that. Now, once you know your self-employment income, then you can start determining how much you're eligible to contribute. And we're very hands-on in helping customers with that educational content specific to their situation. But in terms of how much you can contribute, it's helpful to understand that you've got different limits, right? You have the overall limit, and then there's different limits that will depend on the type of contribution that you're looking to make. So looking at the overall limit for 2024, that's $69,000. And then if you're age 50 or older, you're eligible to make a catch-up contribution equal to $7,500. Now, these limits go up with inflation. So for 2025, the overall limit increased to $70,000. You still have that same $7,500 catch-up contribution if you're age 50 or older, but now they've introduced with Secure Act a super catch-up contribution limit. So for those ages 60 to 63, instead of being able to contribute another $7,500, you're actually able to make this super catch-up contribution amount, if you have the self-employment income to justify it, of $11,250 for a total overall limit of $81,250 if you're age 60 to 63 for 2025. So that's the overall limit. And then you've got different buckets of contributions that one is able to contribute, right? A solo 401k has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because when one is self-employed, they're both the employee and the employer, so they can make multiple types of contributions. And then if you have a plan like ours that allows it, you can also make Roth contributions, voluntary after-tax contributions, in addition to both the employee and the employer. So that's important to understand. You got these different contribution buckets. So now let's start to look at the limits that apply to each bucket. So first you have the employee bucket, right? Employee contributions. Another phrase for that would be salary deferral. So the limit for employee contributions is 100% of your self-employment compensation, dollar for dollar, up to $23,000 for 2024, plus an additional $7,500 if you're age 50 or older. This is where the catch-up contribution comes in if you're age 50 or older. Now for 2025, the employee contribution limit increased to $23,500. Again, $7,500 if you're age 50 or older for a total of $31,000, or the super catch-up contribution kicks in for 2025, taking you all the way up to $34,750 because it's $23,500 plus the additional $11,250. So keep in mind, it's 100% of self-employment compensation. So this is after you run the pre-calculation. Line 31 is Schedule C, less 1/2 of the self-employment tax. And we're going to go through multiple examples to really paint the picture here. Now, another key point to understand is that when we're talking about the employee contribution limit, it applies at the employee level. So across all the plans that the employee contributes to. So in other words, if that self-employed person has a day job and maxes out contributions to their day job 401k, they're not going to be able to make any more employee contributions to the solo 401k because the employee contribution limit applies at the employee level. Now, one exception to that requirement to aggregate across all plans that the employee contributes to is a 457 governmental plan. In that case, contributions do not have to be aggregated. Second key point here is that with a plan like ours, employee contributions can be contributed as pre-tax contributions or as Roth contributions, or even a mixture of pre-tax and Roth. Now, if the individual chooses to make employee contributions as Roth contributions, they need to be deposited into a separate sub-account. And as part of our onboarding process, we're helping customers open up the requisite number of accounts. So say pre-tax and Roth account at the bank or brokerage of choice. Now let's go into a different bucket. So you have the employer contribution bucket. So in addition to employee, you got the employer because you're both the employee and the employer when you're self-employed. Another phrase for employer contributions is profit sharing. So just like with the employee contribution limit, you start with your self-employment income. Here, the employer contribution limit is actually a percentage of your self-employment compensation. Remember, that's line 31 of Schedule C, less 1/2 of the self-employment tax. So after you run that pre-calculation, multiply times 20%, that's how much you can contribute as an employer contribution. Now, you want to be cognizant that the sum of all the contributions that you end up making, employee, employer, and voluntary after tax to the solo 401k, doesn't exceed the overall limit. Remember, that's $69,000 for 2024, and then it goes up to $70,000, and then additional if you're age 50 or older. Now, unlike the employee contribution limit, where that applies at the employee level, so in other words, you have to aggregate all contributions that the employee makes to all plans, so including like a day job plan. The employer contribution limit applies just at the employer level. This is why employers don't have to ask their employees if they've made contributions to other plans. So one's ability to make an employer contribution to their solo 401k is not reduced by contributions that they make to a day job plan. So that now one exception to that rule that you don't have to aggregate for purposes of determining how much can be contributed as an employer contribution is the 403b exception. So all contributions made to the 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. Now, Secure Act 2.0 introduced a new type of employer contribution. So historically, employer contributions were always made as tax deductible. They were always made as pre-tax contributions. Secure Act 2.0 now allows for employer contributions to be made as Roth contributions. For our customer base, though, this was not a big deal because our plan already allowed for making mega backdoor Roth contributions. And most who were focused on making Roth contributions, they just choose to simply make voluntary after-tax contributions. We're going to talk about voluntary after-tax contributions here in a second, and would decline to make employer contributions as Roth contributions. Why would that be? Well, number one, the individual doesn't need as much income to justify the contribution that they want to make. So what do I mean by that? Well, remember, the employer contribution limit is a percentage of your self-employment compensation. So for a business tax as a sole proprietorship or a single member LLC or an independent contractor with the income reported on Schedule C of the 1040, that employer contribution limit is 20% of their self-employment compensation. So they have to have self-employment compensation equal to 5 times the amount of the employer contribution that they want to make. Whereas if someone makes voluntary after-tax contributions, they can contribute 100% dollar for dollar of their self-employment compensation up to that voluntary after-tax limit. So they don't need as much self-employment income to justify the contribution. From a deadline perspective, the employer contribution deadline and the voluntary after-tax contribution deadline is the same. So it's a wash. Another reason why someone would choose to make voluntary after-tax contributions instead of making employer contributions as Roth contributions is more flexibility with those voluntary after-tax funds. So typically you can't transfer money out of a solo 401k, even if it's going to another retirement account, until you've met a triggering event, such as being age 59 and a half or older. A big exception to that general rule, though, is voluntary after-tax funds. So voluntary after-tax solo 401k funds may be transferred out of the plan, such as to a Roth IRA, without needing to meet a triggering event. Whereas if somebody makes employer contributions as Roth contributions and then later wants to transfer them to a Roth IRA, they would first have to meet a triggering event. Now, if someone does end up making employer contributions as Roth contributions, here's some common FAQs. Do I need to deposit those employer contributions made as Roth contributions in a separate account? No, you don't. Those employer contributions made as Roth contributions can be deposited into the same bank or brokerage account that's set up for Roth solo 401k funds. So your Roth employee contributions and Roth employer contributions can be deposited into the same account. What is the contribution limit for employer solo 401k contributions made as Roth contributions? Well, it's the same limit that applies to employer contributions generally. Whether it's pre-tax or Roth employer contributions, it's going to be 20% of self-employment compensation for a business tax as a sole proprietorship or single member LLC tax as a sole proprietorship, or someone who otherwise reports their self-employment income on Schedule C of their 1040. Last FAQ, how do I report employer solo 401k contributions made as Roth contributions? Well, this was an open question when Secure Act 2.0 first allowed employer contributions to be made as Roth contributions. And the IRS took almost a year to resolve this question, to answer this question. Per IRS Notice 2024-2, Roth employer contributions are reported as tax deductible on the employer's return for the year for which the contributions are made. So in other words, the 1040 for a business taxed as a sole proprietorship or with income reported on Schedule C of their 1040, but then reported as taxable to the employee for the year for which the contributions are deposited. So it's not uncommon for self-employed individuals to be making contributions for the prior year. In other words, here we are in 2025, someone is making contributions for 2024, right? As long as they make those 2024 contributions by the business tax return deadline, including extension. So that means it's going to reduce their taxable income, right? It's going to be tax deductible on their 2024 1040 if their business is taxed, for example, as a sole proprietor. But then it'll be taxable to the employee for the year in which the contribution is deposited. In other words, it'll be taxable on their 2025 1040 via 1099-R. Okay, great. Now let's go to the voluntary after-tax contribution limit, and then we're going to apply these limits to different scenarios and examples to be able to paint the picture. So the voluntary after-tax solo 401k contribution limit is the lesser of self-employment compensation or the overall limit. Another way to say that is you can contribute 100% of your self-employment compensation dollar for dollar up to the overall limit. What is the overall limit? Well, it's $69,000 for 2024, $70,000 for 2025. Now, and a couple of important points, right? You still need to honor that overall limit. So if additional contributions were made to the solo 401k, like employee or employer, those together with the voluntary after-tax contributions cannot exceed the overall limit. Another important point, what if you're age 50 or older, right? We know there's the catch-up contribution. Remember what we said, that catch-up contribution is made as a salary deferral. It's either made as a pre-tax or a Roth. It's not made as an after-tax. But at the same time, you can ignore those catch-up contributions for purposes of aggregating and determining whether the overall limit has been made. So in other words, if you're age 52 and you're trying to make contributions for 2025 and you have the self-employment income to justify it, if you make a $7,500, say, Roth contribution to your Roth solo 401k account as an employee contribution, and that's the only contribution that you made, and you have the self-employment income to justify it, you can make an additional after-tax contribution of $70,000. So you still end up being able to make the full $77,500. It's just that the catch-up contribution is not made to the after-tax account. Now, unlike employee contributions, where you have to aggregate across all plans that the employee is making contributions to, contributions made to a day job plan do not impact the ability to make voluntary after-tax solo 401k contributions unless the day job plan is a 403B, in which case you do have to aggregate all employee and or employer contributions made to the 403B together with the voluntary after-tax contributions or other contributions that you want to make to the solo 401k, and the sum cannot exceed the overall limit. Now, just like the employee Roth contributions, where those employee Roth contributions need to be deposited into a separate sub-account, likewise, voluntary after-tax contributions need to be deposited into a separate sub-account. This is how you end up with 3 different accounts: pre-tax, Roth, and after-tax, or 6 different accounts. Let's say there's a husband and wife that are both working in the same business, both participating in the same solo 401k. Each could have pre-tax, Roth, and after-tax for a total of 6 accounts. So now let's start to go through the contribution scenarios. The way that we like to do this is through a base scenario with different assumptions. Then we tweak the basic assumptions to illustrate different points. So with our base scenario, we're going to assume you've got a self-employed business where it's taxed as a sole proprietor. It could be a single member LLC taxed as a sole proprietor, or an independent contractor like a 1099 NEC independent contractor that reports their income on Schedule C of their 1040. Let's assume it's one participant who's under 50 years of age, does not make contributions to another plan like a day job plan. Let's presume that their goal is to maximize first pre-tax contributions and then make additional contributions if they're able to as either a Roth or voluntary after-tax contributions. Let's also presuppose that they have $100,000 of self-employment compensation. In other words, after running that pre-calculation of line 31 of Schedule C less 1/2 of the self-employment tax, the product of that pre-calculation is $100,000. Finally, let's assume that the employer contributions are made as pre-tax contributions, not as Roth contributions. So with that base scenario, how much can this individual contribute? Well, for 2024, they're able to contribute 100% of their self-employment compensation. Remember, we're assuming that's $100,000, dollar for dollar, up to $23,000. Then they can make an employer contribution of 20% of their self-employment compensation. So that's another $20,000. So now they have $43,000 in their pre-tax account. Now they can do the difference up to $69,000 as a voluntary after-tax contribution. So that's another $26,000. They could then move that over from the voluntary after-tax account to their Roth solo 401k account. So at the end of the day, they've got $43,000 in their pre-tax account, $26,000 in their Roth account. So now let's talk about 2025. So again, 100% of their self-employment compensation, dollar for dollar, now up to $23,500 going into that pre-tax account, because that's their first objective, is to maximize pre-tax contributions. They can do 20% of that same $100,000 as an employer. And now the overall limit is $70,000. So they can go up to $70,000 as a voluntary after tax. So that's another $26,500, which they then move over to the Roth. So at the end of the day, they have $43,500 in their pre-tax account, $26,500 in their Roth account. So now let's go back to the base and change the assumption. Instead of $100,000, let's assume they only have $50,000 of self-employment compensation. So the employee contribution amount is not going to change. It's still 100% of that self-employment compensation up to the limit. The employer contribution amount will change because now it's 20% of $50,000, so it's $10,000. Likewise, the voluntary after-tax limit will change. So this is a good illustration of the total amount of contributions that can be made to the plan cannot exceed the self-employment compensation. You can't save more than you earn. So now they can do the difference up to $50,000. For 2024, that's another $17,000 that they're making as a voluntary after-tax contribution. So for 2024, they've got $33,000 in their pre-tax solo 401k account, $17,000 in their Roth solo 401k account. For 2025, they're able to make $16,500 as a voluntary after-tax solo 401k contribution, which then gets moved over to their Roth solo 401k account. So for 2025, they have $33,500 in their pre-tax solo 401k account, and then $16,500 in their Roth account. So now let's go back to the base, back to having $100,000 of self-employment compensation. But now let's assume that this individual does participate in a day job 401k plan and then max out contributions to that plan. How does that change how much they can contribute to the solo 401k? So they're not going to be able to make any more employee contributions because remember, this scenario illustrates how the employee contribution limit applies at the employee level. And they've already maxed out contributions to their day job plan. So they're not going to be able to make any more employee contributions to the solo 401k. It also illustrates how the employer contribution limit and the voluntary after-tax contribution limit is not impacted by contributions made to that day job 401k plan. So they're going to be able to make that same 20% of $100,000 contribution as a pre-tax employer contribution. And now they can go all the way up to the overall limit as a voluntary after-tax solo 401k contribution, and then move those voluntary after-tax solo 401k funds to their Roth solo 401k. So for 2024, they end up with $20,000 in their pre-tax solo 401k account, $49,000 in their Roth solo 401k account. For 2025, they got $20,000 in their pre-tax solo 401k account, $50,000 after they make that first or after-tax contribution to the after-tax account and then move it to the Roth, $50,000 in their Roth solo 401k account. So now let's go back to the base. Again, we're assuming they don't make contributions to another plan, $100,000 of self-employment compensation. But instead of first maximizing pre-tax contributions and then making whatever else they can as a Roth or mega backdoor Roth contribution, let's assume that they're not interested in making pre-tax contributions and only interested in making Roth or voluntary after-tax contributions. So they're still able to make that same employee contribution amount, but instead of having the funds deposited into their pre-tax solo 401k account, it's going to go directly to the Roth account. They're not going to make employer pre-tax contributions because they're not interested in making pre-tax contributions. Then they just make the difference up to the overall limit as a voluntary after-tax contribution. first deposited into the voluntary after-tax account, and then moved to the Roth. So for 2024, they're going to end up with $69,000 in their Roth solo 401k. For 2025, $70,000 in their Roth solo 401k. So now let's go back to the base scenario, but instead of one person, let's assume it's two participants. So let's assume it's a husband and wife that are both working in the same business, both participating in the same solo 401k plan. So since each participant has the same scenario, right? Same age, same amount of self-employment compensation, right? They each have $100,000 of self-employment compensation. Each person has the same objective, et cetera, et cetera. They're both going to be able to make that same amount that we had in our first scenario. But this scenario just illustrates that the ability to contribute is based on each person's scenario. So each person's age, each person's income, each person's objectives. So now let's go back to the base. We're back to one person, doesn't make contributions to another plan. They want to first maximize pre-tax and then make additional contributions as Roth or voluntary after-tax. And they have $100,000 of self-employment compensation. But now let's assume that they, instead of being under 50, they're 50 or older. Well, how much can they contribute? Well, for 2024, they're going to be able to make the same type of the same contribution amounts that we had in the first scenario, but now they're going to be able to make an additional catch-up contribution amount. So this illustrates how that catch-up contribution is going to be made as an employee contribution. And here, their first objective is to maximize pre-tax contributions. They're going to make that additional catch-up contribution to that employee pre-tax bucket. So now they'll end up with $30,500 of employee contributions made into the pre-tax account, plus an additional $20,000 of employer, right? For a total of $50,500. Now, another good illustration or point that's illustrated here is that voluntary after-tax contribution amount is not reduced by the catch-up contribution. So they're still able to make, in sum, the additional contributions all the way up to $76,500 for 2024. But again, that catch-up contribution is going into that employee bucket. Now for 2025, another good illustration is that you've now got the super catch-up. So the super catch-up is not on top of the 7,500. It's in addition. It's instead of the 7,500. So here, the individual, if they're age 60 to 63 for 2025, instead of being able to make $7,500 catch-up, they're now able to make the super catch-up contribution of $11,250. So in sum, across all the different contribution buckets that they're filling up, they'll end up contributing $81,250. Okay, so now let's go back to the base, back to being under 50 years of age. Here, the individual has maxed out contributions to their day job plan, but instead of being focused on making pre-tax contributions, they're only focused on making Roth and after-tax contributions. So they're not able to make employee contributions because they've already hit their limit under their day job plan. They're not interested in making employer contributions because they only want to make Roth or after-tax contributions. So they'll end up just making the full contribution as a voluntary after-tax contribution all the way up to the overall limit. So 100% of their self-employment compensation up to $69,000 for 2024. So they'll contribute $69,000 as a voluntary after-tax contribution for 2024, then move it to the Roth. For 2025, they'll contribute $70,000 as an after-tax and then move it to the Roth. So they'll end up with $70,000 in the Roth solo 401k for 2025. So now let's go back to the base. Now we're back to being 50 or older. They've maxed out contributions to their day job plan. Again, their goal is still just to make Roth and or after-tax contributions. So this is a great illustration that you end up in the same place, right? They can't make employee. They're not interested in making employer. They just make the full voluntary after-tax contribution, not voluntary after. So this illustrates how the voluntary after-tax contribution limit doesn't increase when you're age 50 or older. Because remember, you're making that catch-up contribution to your employee bucket. And here, we're presuming that they've already maxed out. So they've made, for example, $30,500 or $31,000 for 2025 to their day job plan. All right, now let's go back to the base. It's two participants. They're each under 50. Each has maxed out contributions to their day job plan. They each have $100,000 of self-employment compensation. And their goal is to only make Roth or voluntary after-tax contributions. So the limits are going to be the same as what we saw before. So this just, again, emphasizes that when you have two participants that are participating in the same solo 401k plan, Each person's ability to contribute to the plan is based on their situation. So their self-employment compensation, their age, their objectives, etc. All right, so hopefully that's helpful to illustrate some of those important concepts. Now let's turn to some of the resources. So we have an online calculator. You can find it easily at mysolo401k.net. Just on the drop-down menu under Learn, click on Online Tools, and you'll easily find it. So it's a great tool, for example, to help you calculate 1/2 of the self-employment tax. It'll help you calculate self-employment compensation. And then from there, you can determine the employee contribution amount, the employer. Now, some things that are outside the scope of the calculator, it doesn't contemplate if you want to make after-tax contributions. It likewise doesn't contemplate if you're making contributions to a day job plan. So in both of those scenarios, you'd have to modify. So now let's keep going with some of the mechanics, right? How do you make contributions, right? What are those contribution steps? Well, you can make contributions, of course, by check. It's totally acceptable also to make contributions via electronic transfer. Now, we are neutral as far as where the accounts are at. We're very hands-on in helping customers open up accounts at the bank or brokerage of choice, and we've helped customers open up accounts at hundreds of different banks, many different brokerages. So the specific electronic deposit procedures for your particular bank or brokerage where your solo 401k account is at, of course, is going to vary, right? So some places will allow it, some places may not, right? Some may allow it, but only for certain types of account, or the funding account might be limited. So for example, with the brokerage firms, most don't allow electronic deposit from an external account where the name on the external account doesn't match the name on the brokerage account. So in other words, the name of the external account is not in the name of the plan, right? Because that brokerage account, of course, is going to be opened up under the name of the plan. One exception to that general rule, though, is Fidelity, which does allow for electronic deposit from an external account where the name on the external account doesn't match the name on the account at the name on the brokerage account. Each participant is going to deposit his or her contributions into separate sub-accounts. You need separate accounts also if you're going to have pre-tax, Roth, and after-tax. This is how you might end up with 6 accounts, right? If you got 2 participants, each person is making pre-tax, Roth, and after-tax contributions. That's a total of 6 accounts. Contributions can be deposited in one lump sum or over a series of contributions, as long as it's deposited by the deadline. Those contributions can be transferred from personal or business account. All of that is acceptable from a solo 401k perspective. So what is the deadline? Well, as long as the plan is set up by the end of the year, that'll preserve the ability to make all types of contributions by the business tax return deadline, including extension. This is per IRS publication 560, which is a landmark guidance for self-employed retirement plans like solo 401ks. So, but let's put some more meat on the bones, because with Secure Act 2.0, there's an additional time specifically for businesses that are taxed as sole proprietors, or an LLC taxed as a sole proprietor. So your standard deadline that gives you the most options to make contributions is the December 31st deadline. So if the plan is set up, in other words, you signed up with us by December 31st, then you would have preserved the ability to make all types of contributions, whether employee, employer, or voluntary after tax, by the business tax return deadline, including extensions. So for a business tax as a sole proprietorship, that's April 15th or October 15th if you file a timely extension for your 1040. Now there's a special deadline, though, for sole proprietors who didn't set up the plan by December 31st. So there's more time, right? As long as the plan is set up in time to make those contributions by April 15th, if the business is taxed as the sole proprietor, or an LLC taxed as a sole proprietor, you could still make all types of contributions for 2024, even employee, but you'd have to deposit that by April 15th. Otherwise, if you're talking about employer or voluntary after-tax contributions, it's still possible to set up a plan and make those contributions as well. And those contributions can be made all the way up until the October 15th deadline if a timely extension is filed for the 1040. So this is a great slide, as it just highlights that the ability to contribute is based on how the business is taxed. right? So again, if it's a sole prop or an LLC tax as a sole prop, it's going to be April 15th or October 15th. Likewise for 2025, it's going to continue. So as long as you sign up by the end of the year, you're going to preserve maximum flexibility, because you'll even be able to make the employee contribution by the business tax return extended deadline if you file a timely extension for that 1040. So let's keep going with some of the great mechanics. So how do I report contributions? Well, it depends on the type of contribution that you're referring to. So if someone's making a voluntary after-tax contribution or a Roth contribution as an employee, right? So that's that, for example, $23,500 limit if you're under age 50 for 2025, and the business is taxed as a sole proprietor, those contributions are not reportable on the 1040. Now, if it's a pre-tax employee contribution, it'll be reported on line 16 of Schedule 1 of your 1040, because that's pre-tax. You got to reduce your taxable income to get that pre-tax benefit. Now, if it's an employer contribution, regardless of whether it's pre-tax or Roth, it's going to be reportable on line 16 of Schedule 1 of the 1040 for the year for which the contribution is made. And then it's going to be taxable to the employee for the year in which it's deposited, right? So if somebody's making a 2024 employer contribution here in 2025, and that employer contribution is made as a Roth contribution, that's going to reduce the taxes. That's going to reduce the taxable income for 2024, because it's reported as tax deductible for the year for which the contribution is made, 2024. But then it's going to still need to be after tax because it's a Roth contribution. So it's now taxable to the employee for the year in which it's deposited. In other words, 2025 via 1099-R. What about matching contributions? That's a common question. So a lot, and it's understandable, right? Because a lot of individuals' experience with the 401k may come from corporate America, where they might have received a match to their 401k contribution. Matching contributions don't apply to a solo 401k. So no, you cannot make matching contributions to a solo 401k. Matching contributions only apply to a full-time employer plan, like your day job 401k plan. Solo 401k contributions only consist of employee and profit sharing contributions. A matching contribution is when the employer matches what the employee has contributed, whereas profit sharing contributions may be made to the solo 401k even if no employee contributions are made. In other words, that employee contribution is a prerequisite of the match. So it's great, right? Within profit sharing contributions, right? The individual might have maxed out contributions to their day job plan, so they're not even eligible to make employee contributions to the solo 401k. But making that employee contribution to the solo 401k is not a prerequisite for making profit sharing contributions. So even if they haven't made any employee contributions to the solo 401k because they hit their max on their day job plan, they're still going to be able to make employer profit sharing contributions to the solo 401k based on the limit, based on their self-employment compensation, etc. What is not a contribution? So this is another good point of clarification, because of course, there's many scenarios where funds are being deposited into the solo 401k. So sometimes the question will come up, well, does this count towards my contribution limit? And it does, and these are scenarios that are not contributions, so that doesn't count towards the contribution limit. Examples would be amounts rolled over from an existing retirement account, like a former employer plan or a non-Roth IRA. There's no limit on how much you can roll over, and it's not going to count as a contribution. It's not going to reduce how much you can contribute to the solo 401k. Earnings from your solo 401k investment. One of the top use cases for our customers is the ability to invest in alternative investments like real estate. So they might be collecting rent from their real estate investment properties. So that, of course, is funds being returned to the solo 401k. That likewise doesn't count as a contribution. That likewise doesn't reduce how much they can contribute to the solo 401k. Amounts converted within the solo 401k. So sometimes individuals are transferring money that's already in the solo 401k from one sub-account to another. It could be a pre-tax to Roth in-plan conversion. It could be a voluntary after-tax to Roth transfer because someone's making a mega backdoor Roth contribution. In both of those scenarios, money is being deposited into the solo 401k, but that in-plan conversion doesn't count as a contribution It doesn't reduce how much they can contribute to the solo 401k. Lastly, repayment of solo 401k participant loans, right? Another great use case is the ability to borrow from your solo 401k. You could use those proceeds for an emergency purpose or really any purpose. And that is going to require repayment of the solo 401k participant loan, because that's going to have to be structured as a loan where it's going to have to be paid back in monthly or quarterly payments. So that's, again, a deposit of funds into your solo 401k. But that repayment of that solo 401k participant loan doesn't count as a contribution, doesn't reduce how much you can contribute to the solo 401k. All right, so the bonus content, solo 401k now qualifies for a $1,500 tax credit. Under the Secure Act, there was a number of tax credits that were introduced and made available to small businesses that offer a 401k plan. So one of those tax credits is the startup cost credit. That is not available to a solo 401k because one of the prerequisites to be eligible for the startup cost credit is having non-owner employees. And of course, a solo 401k plan is for an owner-only business. So it's not going to have non-owner, non-spouse employees participating in the solo 401k. Therefore, a solo 401k plan is not eligible for the startup cost credit. But there's a second credit that was made available under the Secure Act, which is for for a plan that has the automatic participation feature. So that credit is not limited to businesses that have non-highly compensated employees. So even an owner-only business that has a solo 401k plan that includes the automatic participation feature is eligible for the $1,500 tax credit. So it's a $500 per year credit for 3 consecutive years. It could be for, of course, a brand new plan, or even if someone has a pre-existing solo 401k plan that's upgraded to our plan, now they're going to be eligible to start claiming the credit. It's also noteworthy that unlike the startup cost credit, that's a function of the startup costs, the automatic participation credit, the solo 401k tax credit, is not based on the actual cost to set up and maintain the solo 401k. So if someone signs up for a new plan here in 2025, they'd be eligible to start claiming the credit when they file their 2025 taxes, and then again for 2 more years for a total of $1,500. If someone has an existing solo 401k and then upgrades to our plan, they'd be eligible to start claiming the credit when they file their 2025 taxes, and then again for 2 more years for a total of $1,500. The impact to the cost is tremendous. So we have a flat fee structure. We charge $650 as the initial cost, which includes the $525 establishment fee, plus the first $125 annual fee. Then starting 12 months later, for example, January of next year, if you were to sign up now, we charge our $125 annual fee that covers the second year. So the net cost after factoring the tax credit is tremendous. For example, in the first year, it's $150. In the second year, the value of the credit is actually going to exceed the cost. Likewise, in the third year. So ultimately, at the end of the day, the $1,500 in solo 401k tax credits is going to more than cover our fees for the first 7 years. So if you add up all our fees for this first 7 years, it doesn't even amount to $1,500. It's also noteworthy that this is a tax credit, not a tax deduction. So it's a dollar for dollar reduction in your tax liability. So unlike a tax deduction where you first reduce your income upon which your tax is calculated, with a tax credit, you first determine your tax liability, then you're able to reduce that tax liability dollar for dollar by the amount of the tax credit. So again, to be eligible, you need to have a plan like ours that includes the automatic contribution feature. What is the automatic contribution feature? Well, it's a plan that sets a default 3% contribution percentage. However, you, as the solo 401k participant, have the right to opt out of that default 3% contribution amount. Opting out of the default 3% contribution amount doesn't mean that the business is not eligible to claim the credit. On the contrary, it still would be, because the plan still has the credit. Opting out of the default amount will now allow the solo 401k participant to make contributions in whichever amount or schedule they prefer, obviously subject to the deadline and the contribution limits. Again, if you have an existing solo 401k plan, it can be upgraded to our plan to include the automatic contribution feature, so the business is now eligible to claim the credit. So the credit is claimed by filing Form 8881. We provide a deep dive webinar we hosted with an IRS enrolled agent that goes through step by step how to claim the credit. let's go through some examples. So Lindsay's self-employed. She sets up a plan here in 2025. She would be eligible to start claiming the credit when she files her 2025 taxes, and then again for 2 more years for a total of $1,500, as long as she continues to maintain the solo 401k plan with the automatic contribution feature. Whereas Brad, he's a solo attorney with no employees. So, and again, with Lindsay, she was amending her plan. So if she did that here in 2025, she'd be able to claim the credit. Whereas Brad, he's setting up a new plan. But likewise, as long as he sets up a new plan here in 2025, he would be able to claim the credit, starting with the 2025 tax return, and then again for 2 more years for a total of $1,500, as long as Brad continues to maintain the solo 401k plan with the automatic contribution feature. So again, resources, we have these deep dive webinars at least once a week. Subscribe to YouTube, you get all the notifications. We go live twice a day with office hour, Q&A style sessions. The first one's at 10 a.m. Pacific, 1 p.m. Eastern. We're back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern. You can always find the schedule at mysolo401k.net/webinar. Please also feel free to come to our community. We have a community of over 30,000 members. We have vibrant forums. We have a library of videos and webinars. It's totally free to join. All are welcome. We have the industry's first AI chatbot. You can use it at solo401k.ai. It's a great way to quickly find answers to questions and resources. Please, again, subscribe to the YouTube channel so you get all the notifications, as we're in the middle of contribution season. So we're going to have a lot of great content here. So please subscribe. All right, so now let's go to some of the questions that are being chatted up. So I have an LLC, taxes, and S Corp. I plan to make employee Roth contributions for 2024 before March 15th, 2025. I have not made that contribution yet. Should I include that in the W-2 for 2024 before I make the employee Roth contribution? Since the W-2 deadline is January 31st, I need to file W-2 now before I make the contribution. Report on box 2 of W-2 with code AA for employee Roth contribution, right? So yes. So as long as the plan was set up on or before December 31st, 2024, the solo 401k participant would have preserved the ability to make all types of contributions, including employee contributions by the business tax return deadline, including extension in 2025. Now, as far as how to report those contributions, I'm trying to pull that page up. There it is. Oh, this is for sole prop. But yes, it's box 12 of W-2 with code AA. That is correct. We have a great page on our website specifically for corporations, and we recently updated it with last week's deep dive session. So there's a link to that session there. Let me pull up that page and I'll chat it over to you just to have it there for your reference. You can access the slides. You can, of course, access the webinar. And we've got it's the same type of content here. And there's a slide that talks about how to report. Thank you for bringing the good question. For Roth employer contribution, I need to report on Form 1099-R now if I plan to deposit in 2025. So if it's an employer contribution made for 2024, that'll be, and this is addressed on that same webinar that I mentioned, that'll be reported on the employer's return. So the 1120S, if the business is taxed as an S Corp for 2024. So it'll reduce the employer's taxable income for 2024. But it'll be reported on a 1099-R taxable to the employee for the year of the deposit. So if you were to go to our website, mysolo401k.net/forms, you would find there's a pre-tax to Roth conversion form. So you could use that same form because really from a reporting perspective, there's no difference, right? It's as if you made an employer pre-tax contribution and then you moved it from the pre-tax account to the Roth account. You don't literally have to go through those steps. You can deposit directly to the Roth account, but from a reporting perspective, it's going to be the same. So it's going to be taxable to the employee for 2025 for the year of the deposit. If you submit that online form to provide us the information, we'll then prepare the applicable 1099-R as an optional free service. In other words, no additional charge. how to report employee voluntary after-tax contribution. So it's not reportable for a business, for any type of business. Likewise, even for a business taxed as an S Corp. If you look at the W-2 instructions, they're clear that reporting voluntary after-tax contributions is voluntary. And we've got more on the webinar and on the slides that I referenced up above. If I'm eligible for an after-tax contribution, if I'm over 50 and W-2 wages after max deferrals is $8,061. So you're over 50 and W-2 wages after max deferrals is $8,061. So let's assume that let's just make it 8,000 to make it round number. To make it a round number, let's assume that we're talking about 2024, right? So the individual would have made $23,000 as an employee, $7,500 as a catch-up for a total of $30,500. So now let's assume that they've got another $8,000 in wages, so now they have $40,500 in W-2 wages from their business tax as an S Corp. So yes, they could make another $8,000 of contributions as a voluntary after-tax contributions, assuming they don't make any other contributions. In other words, they don't make any employer contributions to the plan. Because in this scenario, right, they have $40,500 of W-2 wages. They contributed $30,500 as an employee contribution because they're 50 or older for 2024, right? We're assuming they would have set up the plan on or before December 31st, 2024, so they'd still have time, for example, to make that employee contribution. They would now be able to make an additional $8,000 as a voluntary after-tax contribution, right? Because the voluntary after-tax contribution limit is 100% of their wages, dollar for dollar, up to the overall limit. Here, their wages are less than the overall limit. Plus, you've got to make sure that the sum of all the contributions that you make, right, employee plus after-tax, doesn't exceed the lesser of their W-2 wages or the overall limit. So in short, they'd be able to contribute that additional amount, $8,000, as a voluntary after-tax contribution. Assuming they have a plan like ours that allows it, they'd have to put the voluntary after-tax contribution into a separate voluntary after-tax account. They would have time to do that, right? Because it would have to be made by their business tax return deadline, including extension. Then they can move it from the after-tax account to the Roth account. So they need a Roth account if they don't already have one. The reporting of that contribution is not required, but the second step, the move from the after-tax to the Roth, is reportable on a 1099-R. And that's where we have forms on our website at mysolo401k.net/forms. You can see there's one for after-tax to Roth transfer. So clients submit that online form to give us the information we need to prepare the 1099-R. Thank you for bringing the good question. Thank you so much for the good participation. We certainly appreciate it. Please, again, subscribe to our channel. Please participate in our forums. Please come to our webinars. We appreciate always to discuss these topics. Or it looks like that might be it for today. Thank you so much, everyone.